Before we begin, please remember that I am not a licensed financial advisor, mortgage loan officer, or real estate professional. The information provided in this video is for educational and informational purposes only and should not be considered financial, legal, or tax advice. Buying a home is one of the biggest financial decisions you will ever make. Always consult with a qualified professional who can assess your individual situation before making any decisions. What if I told you that getting approved for a mortgage has almost nothing to do with how much money you have in your checking account right now? What if I told you that two people, both earning the exact same six-figure salary, could apply for the same loan on the same house, and one would get instantly approved while the other gets a flat-out rejection? It happens every single day in America. The dream of homeownership for millions of people dies in a cold, confusing email from an underwriter, with no real explanation why. Feels like a secret club with rules nobody ever tells you. You hand over your tax returns, your pay stubs, your bank statements, basically a financial diary of your entire adult life. You push submit and hold your breath, hoping some faceless person in an office somewhere stamps approved on your future. But it's not a person, not really. It's an algorithm, a cold calculating system that decides if you are worthy. Well, this video is your key to cracking that system. We are going to open up the lender's black box and show you the exact formula they use. By the time you finish watching this, you will understand the lender's playbook better than they expect you to. You will know precisely how they view your income, your debt, your credit, and your savings. You won't have to guess or hope anymore. You will be able to look at your own finances and calculate with a stunning degree of accuracy whether you'll be approved and for how much. This is the knowledge that turns anxiety into confidence and puts the power back in your hands. So let's get into it. Forget everything you think you know. Lenders don't see you as a person. They see you as a risk profile, and they measure that risk using three fundamental pillars. Think of it like a three-legged stool. If any one of these legs is weak, the whole thing collapses and your application gets denied. These three pillars are: number 1, your ability to repay the loan; number 2, your proven willingness to repay your debts; and number 3, your collateral and commitment to the deal. Today we are diving deep into the single most important pillar, the one that stops most applications dead in their tracks: your ability to repay. This is all about your income and your debt. And right away we hit the first major myth. Lenders don't actually care about how much you make. That's right. Your big, impressive salary on its own means very little. What they care about is stable and predictable income. They want to see a track record. The magic number for lenders is 2. They want to see a 2-year history. 2 years of W-2s. 2 years of tax returns. 2 years of consistent employment, preferably in the same job or at least the same industry. Why? Because they aren't lending to the person you are today. They are lending to the person you're going to be for the next 30 years. They need to believe beyond a reasonable doubt that your income stream isn't going to dry up next month. If you've been at the same salary W-2 job for 5 years, congratulations, you've just cleared the first hurdle. But what if you're a job hopper? What if you just graduated college? What if you're self-employed or part of the gig economy? This is where things get complicated. If you've switched jobs recently but it was for a promotion with higher pay in the same field, that's usually fine. They see it as positive career progression. But if you jumped from being a nurse to a software developer 6 months ago, they're going to hit the brakes. They have no way to predict if your new career is stable. If you're a recent graduate entering the workforce, you get a special exception. Lenders will often accept your college transcripts in place of a 2-year work history, especially if your degree is directly related to your new job. You'll still need to provide an offer letter and your first 30 days of pay stubs, but you don't necessarily need the full 2 years. Now, for everyone who is self-employed, a freelancer, or an independent contractor, listen very closely. You face the highest level of scrutiny. It's not fair, but it's reality. Lenders see you as a higher risk. To prove your ability to repay, you can't just show them your last few invoices. You will need to provide your last 2 full years of federal tax returns, business and personal. And here's the painful part. They will average your net income from those 2 years. If you made $100,000 last year but only $30,000 the year before, they won't qualify you based on that $100,000 income. They'll average the two, qualifying you based on an income of $65,000. And if your income went down last year, they will almost always use the lower, more recent number. They want to see stable or increasing income, period. The same logic applies to variable income for W-2 employees. Overtime, commissions, bonuses, Lenders love to see it, but they don't trust it. They will not just add it to your base salary. They will demand to see a 2-year history of you earning it, and then they will use a 2-year average. So if you had one monster commission check last year, don't expect it to supercharge your borrowing power. It has to be consistent. Okay, so once the lender has established your qualifying income, that stable, predictable number they can count on, they move to the most critical calculation in the entire mortgage process. This is the heart of the machine. It's called the debt-to-income ratio, or DTI. Your DTI is a simple percentage that tells the lender how much of your monthly gross income is already spoken for by your debts. There are 2 DTI numbers they calculate. The first is the front-end ratio, also called the housing ratio. This is your future, all-in housing payment. We're talking principal, interest, taxes, and insurance, or PITI, divided by your gross monthly income. For example, if your new total mortgage payment is going to be $2,000 a month, and your gross income is $8,000 a month, your front-end DTI is 25%. Most lenders want to see this number stay below 31%. But the number that really matters, the one that gets all the attention, is the back-end ratio. This is the big one. This ratio takes your future housing payment, the PITI we just mentioned, and adds all of your other monthly debt obligations. We're talking your minimum credit card payments, your car loan, your student loans, any personal loans, everything that shows up on your credit report. Then they divide that total sum by your gross monthly income. Let's run a quick example. Let's say your name is Alex. Alex makes $7,000 a month before taxes. That's the gross income. The new mortgage payment, PITI, for the dream house is $2,200. Alex also has a $400 a month car payment and $300 a month in student loan payments. We add it all up. $2,200 plus $400 plus $300 equals $2,900 in total monthly debt. Now we divide that by the gross monthly income. $2,900 divided by $7,000 equals 0.414. That means Alex's back-end DTI is 41.4%. So, is 41.4% good or bad? For most conventional loans, the absolute maximum DTI allowed is 43%. That is the magic line in the sand. If Alex's DTI was 44%, it's an automatic denial from the algorithm. No human intervention, no sob story, just computer says no. Alex, at 41.4%, is safely under the wire and clears the hurdle for this first pillar. Now, there are exceptions. Government-backed loans like FHA or VA loans can sometimes allow for a DTI as high as 50%, or in rare cases even higher, but you'll need other compensating factors, like a high credit score or significant cash reserves. But for most people walking into a bank, that 43% number is the wall. This DTI calculation is why your salary alone is meaningless. A doctor earning $20,000 a month but carrying $10,000 a month in student loan and luxury car payments could easily get denied, while a teacher earning $5,000 a month with zero debt could sail through the approval process. It's not about how much you make. It's about how much you owe relative to how much you make. This is the core of determining your ability to repay. So, you've proven you have stable, predictable income. You've mastered the DTI calculation and you know you're under that 43% threshold. You've successfully built the first and arguably the most difficult pillar of your mortgage application. But that's only 1/3 of the puzzle. The lender's very next question is a big one. We know you can pay us back, but will you? Their answer to that question isn't found in your bank account. It's hidden in a single powerful 3-digit number. We're talking, of course, about your credit score and the story it tells about your financial character. And that is where we're going next. Think of your credit score as your financial handshake. Before a lender even looks at your income, your savings, or the house you want to buy, they look at this number. It's their first impression. It's a snapshot of your entire history with borrowing money, distilled into a simple score, typically between 300 and 850. To them, it's not just a number. It's a predictor of future behavior. It answers the one question that keeps them up at night. If we lend this person hundreds of thousands of dollars, what are the odds they'll actually pay it back on time every time for the next 30 years? A high score says you're reliable, you're consistent, you're a low-risk investment. A low score, well, it tells a different story. It might whisper about late payments, maxed-out cards, or a history of financial turbulence. And in the world of mortgages, that whisper can cost you a fortune. Let's make this real. Forget abstract numbers for a second. Imagine 2 friends, Sarah and Mike. They live in the same city, work at the same company, and earn the exact same salary. They both have a 20% down payment saved up, and they both find identical starter homes they want to buy for $400,000. They are, for all intents and purposes, the same borrower. Except for one thing. Sarah has spent years diligently paying her bills on time. She keeps her credit card balances low. Her credit score is a stellar 780. Mike, on the other hand, has been a bit more relaxed. He's missed a couple of credit card payments over the years, and he tends to carry a high balance on his cards. His score is a much more average 650. They both go to the same lender on the same day to apply for the same $320,000 loan. The lender offers Sarah, with her 780 score, an interest rate of 6.25%. Her monthly principal and interest payment comes out to about $1,970. Then the lender looks at Mike's 650 score. They see a slightly higher risk, so they offer him a rate of 7.5%. Doesn't sound like a huge difference, right? Just over 1%. But that 1.25% difference pushes Mike's monthly payment up to $2,237. That's $267 more than Sarah, every single month. That's over $3,200 a year. That's a family vacation. That's a significant contribution to a retirement account. That's a car payment, all gone just because of that 3-digit number. But here's the truly staggering part. Let's look at the total cost over the life of their 30-year loans. Sarah, with her great credit, will pay about $409,000 in total interest. Mike, with his average credit, will end up paying over $506,000 in interest. That's a $97,000 difference. $97,000. Enough to buy a luxury car, fund a child's college education, or completely remodel that house he just bought. All vaporized into thin air by a less-than-perfect credit score. So now that you see the stakes, the question becomes, what actually makes up this all-powerful number? How do they calculate it? It's not a mystery. The major credit scoring models like FICO are very transparent about what they value most. And it breaks down into 5 key ingredients. The single most important factor, making up a massive 35% of your score, is your payment history. It's simple. Do you pay your bills on time? Every late payment, from a credit card bill to a car loan, is a black mark. A payment that's 30 days late is bad. 60 days late is worse. And a 90-day late payment can be catastrophic to your score, staying on your report for 7 long years. Lenders see a history of late payments as the biggest red flag imaginable. It shows a pattern of not meeting your obligations, which is exactly what they're trying to avoid. Consistency is king here. The second biggest piece of the puzzle, accounting for 30% of your score, is called amounts owed, or more commonly, your credit utilization ratio. This sounds complicated, but it's just a fancy way of asking, how much of your available credit are you actually using? Let's say you have one credit card with a $10,000 limit. If you have a balance of $5,000 on it, your utilization is 50%. If you have a balance of $9,000, it's 90%. High utilization is another major red flag for lenders. It suggests you might be overextended, relying on credit to live, and potentially close to financial trouble. The golden rule you'll hear is to keep your utilization below 30%. So on that $10,000 card, you'd want to keep your balance under $3,000. But honestly, the lower the better. People with the highest credit scores often keep their utilization in the single digits, below 10%. They use their credit cards, but they pay them off almost entirely every month. Next up, weighing in at 15%, is the length of your credit history. This is all about age. How long have you been responsibly managing credit? Lenders like to see a long established track record. This is why financial advisors scream from the rooftops not to close your oldest credit card account, even if you don't use it much. That card is the anchor of your credit age. Closing it can shorten your average account age and actually cause your score to drop. It's one of the most common mistakes people make when trying to clean up their finances. The fourth ingredient, making up 10% of your score, is your credit mix. Lenders like to see that you can successfully manage different types of debt. A healthy mix might include what's called revolving credit, like credit cards, and installment loans like a car loan, a student loan, or a personal loan. Having a good mix shows you're a versatile and experienced borrower. It's not a deal breaker if you don't have both, but it does help build a more robust credit profile. And finally, the last 10% is determined by new credit. This category looks at how recently and how often you've been applying for new credit. If you apply for 5 different credit cards and a car loan in the span of a month, it looks desperate. Lenders call this credit-seeking behavior. Each one of those applications typically results in a hard inquiry on your credit report, which can temporarily ding your score by a few points. A couple of inquiries over a year or two is perfectly normal. A flurry of them right before you apply for a mortgage? That's a warning sign that you might be in financial distress. So there you have it. Payment history at 35%. Amounts owed at 30%. Length of history at 15%. And credit mix and new credit at 10% each. That's the recipe. That's the formula that determines whether you're a Sarah or a Mike in the eyes of a lender. Now, it's important to understand that lenders don't just see 780 or 650. They see tiers. Generally, a score above 740 is considered excellent. From 670 to 739 is good. 580 to 669 is fair. And below 580 is poor. These aren't just labels. They correspond to different risk levels and, therefore, different interest rates. Sometimes, moving your score by just 10 or 15 points can bump you into a higher tier, unlocking a significantly better rate and saving you tens of thousands of dollars. Your credit score is the story of your past financial reliability. It proves you've been a good steward of debt. But a mortgage lender isn't just concerned with your past. They need to know about your present. They need to know if you can actually afford the monthly payment right now, on top of all your other existing financial obligations. You can have a perfect 850 credit score, but if your current monthly debts are already eating up most of your paycheck, you won't get the loan. The story of your past is only half the battle. The story of your monthly cash flow is the other. And that story is told through an entirely different, but equally important calculation. It's a ratio that can make or break your homeownership dreams, regardless of how perfect your payment history is. It's called the debt-to-income ratio, or DTI. And while it sounds like a dry, technical term from an accounting textbook, it is the single most powerful number that determines how much house you can actually afford in the eyes of a lender. Your credit score tells the lender if you're likely to pay back a loan. Your DTI tells them if you're able to. It's the difference between your character and your capacity. Imagine your total monthly income, before any taxes are taken out, as a big freshly baked pie. That's your gross monthly income. Every slice you have to give away to someone else for a debt you owe, your car payment, your student loans, your credit card minimums, makes your pie smaller. The DTI ratio is simply the lender's way of measuring how much of your pie is already promised to others before you even think about paying for a house or even buying groceries. They want to make sure that after they give you this huge new mortgage payment, you still have enough pie left to, live. Now, this is where it gets interesting because lenders don't just look at one DTI. They look at two. They are often called the front end and the back end ratios, and understanding the difference is absolutely critical. First, let's talk about the front end ratio. This is also known as the housing ratio. It's the simpler of the two. It only looks at one thing: your potential all-in housing expense. This isn't just the mortgage payment. This is the big kahuna, the full enchilada, what the industry calls PITI. That stands for principal, interest, taxes, and insurance. Principal is the part of your payment that actually pays down your loan balance. Interest is the lender's profit for loaning you the money. Taxes are the property taxes you'll pay to your local government. And insurance is your homeowner's insurance. If the property has a homeowners association fee, or you're paying private mortgage insurance, those get bundled in here too. The lender takes that total monthly housing cost and divides it by your gross monthly income. That percentage? That's your front-end DTI. It's a laser-focused look at how much of your income this one new debt will consume. But that's only half the picture. The second, and arguably more important ratio, is the back-end DTI. This is the one you'll hear about most often. The back-end ratio takes that same total housing payment, your PITI, and then adds on all of your other monthly debt obligations that appear on your credit report. We're talking about your car loan payment, the minimum monthly payments on all of your credit cards, even if you pay them off in full each month, your student loan payments, any personal loans, installment loans, or alimony and child support payments. All of it gets added together into one big number. Then that total sum of all your debts, including the new house, is divided by your gross monthly income. That percentage is your back-end DTI. It gives the lender a panoramic view of your entire financial landscape. Now, a crucial question always comes up here. Why do they use my gross income? My pre-tax income? I don't get to spend my gross income. I only get my take-home pay. It's a fair question. The reason is standardization. Your personal tax situation can be incredibly complex. You might have unique deductions, write-offs, or live in a state with a different tax rate than someone else. Using gross income creates a level playing field. It's the one number that allows a lender to compare you, a software engineer in California, to a nurse in Texas, to a teacher in Florida, using the exact same yardstick. It removes the variability of taxes and focuses purely on your earning power. So, what are the magic numbers? What DTI is a lender looking for? Historically, you might have heard of the 28 of 36 rule. This meant your housing payment shouldn't be more than 28% of your gross income. That's your front end. And your total debts shouldn't exceed 36%. That's your back end. But let me be clear, in today's lending world, the 28 of 36 rule is more of a quaint suggestion than a hard and fast rule. The actual limits are much more flexible and depend heavily on the type of loan you're getting. For a conventional loan, the kind backed by Fannie Mae and Freddie Mac, the back-end DTI limit is often around 43%, sometimes 45%. However, if you have what are called compensating factors, like a stellar credit score, a large down payment, or significant cash reserves, the automated underwriting systems might stretch that limit all the way to 50%. Then you have government-backed loans. An FHA loan, for example, is famous for being more forgiving on DTI. It's not uncommon to see approvals with a back-end DTI as high as 55% or even 57% in some cases. VA loans for veterans and active duty service members are even more unique. They technically have no set DTI limit and focus more on something called residual income, the amount of cash you have left over after all your bills are paid. This is where theory crashes into reality. Let me tell you about a couple, we'll call them Mark and Sarah. They had done everything right. They both had 780 credit scores. They had saved up a solid down payment. They got a pre-approval from a lender who told them they were qualified for a $500,000 loan. They were ecstatic. They went house hunting and found it. The perfect place. It was listed at $495,000, comfortably within their budget. It had a great backyard for their dog and was in the perfect school district. There was just one small detail. The property taxes were a little higher than average for the area, and it had a $200 a month HOA fee. They didn't think much of it. They put in an offer, it was accepted, and they went back to their lender, ready to finalize the loan. And that's when they got the call. The loan was denied. They were in shock. How? Their credit was perfect. The price was under their pre-approval amount. The problem was their DTI. Mark had a hefty student loan payment and Sarah had a car loan. When the lender ran the numbers for the pre-approval, they used an estimated amount for taxes and insurance. But the actual taxes on this specific house, plus that $200 HOA fee, pushed their pity payment up by $350 a month. That small increase was just enough to push their back-end DTI from an acceptable 44% to a denied 47%. Their dream was slipping away because of a few percentage points. They were devastated, but they didn't give up. They called their loan officer, desperate for a solution. And this is where the game is played. The loan officer saw that Sarah's car loan only had $3,000 left on it, with a $400 monthly payment. He asked them, "Do you have the cash in your savings to pay that car loan off completely right now?" They did. It would dip into their furniture fund, but it was worth it. They paid it off, sent the proof to the lender, and just like that, a $400 monthly debt vanished from their DTI calculation. The lender reran the numbers. Their back-end DTI plummeted from 47% down to a very healthy 39%. The loan was approved. They got the house. Mark and Sarah's story is a powerful lesson. Your DTI isn't just a number. It's a dynamic puzzle. It shows that your borrowing power isn't just determined by your salary, but by how you manage your monthly obligations. Paying off a small loan or even a single credit card can have a massive impact on what you can afford. Your credit score tells the story of your past promises. Your DTI tells the story of your current ones. But neither of them means anything without the foundation they are built upon, your income. How much you make, how you make it, and how long you've been making it is the engine that drives this entire process. Because your debt-to-income ratio is only as strong as the eye it's built upon. And a lender will scrutinize that income with a magnifying glass. So when an underwriter picks up that magnifying glass, they're not just looking at the number on your paycheck. They're looking for a story of stability, predictability, and reliability. They're trying to answer three fundamental questions about every dollar you claim. Is it continuous? Is it consistent? And is it certain to last? Get these 3 right and you're golden. Get one wrong and the whole structure can start to wobble. Let's start with the first one, continuity. This is the bedrock of income qualification. Lenders want to see a track record. They're not interested in a flash in the pan. They're investing in your future, so they need to understand your past. The gold standard here is a 2-year history of employment. Why 2 years? Because it shows you're not just in a temporary phase. It demonstrates stability through changing seasons, and it gives them a reliable pattern to analyze. For most people with a standard W-2 job, this is simple. You provide your W-2s from the last 2 years and your most recent pay stubs. If you've been at the same company for 5 years, earning a steady salary, you've just passed the first test with flying colors. But what if you've changed jobs? This is where people get nervous, but usually they don't need to be. If you moved from one accounting job to another, and your pay increased, a lender sees that as a positive. It's career progression. You're still in the same line of work, demonstrating a continuous ability to earn in your chosen field. The red flag goes up when the job history is erratic. If you were a teacher, then a truck driver, then you started a dog walking business all within 2 years, the lender can't establish a clear pattern. They have no way of knowing what your stable, reliable income actually is. The exception to the 2-year rule? Recent graduates. If you just graduated with a nursing degree and started your first job at a hospital, the lender will often accept your degree and transcripts as a substitute for that 2-year history. They're making a logical leap. Your intensive, specialized training in a high-demand field makes your future income highly probable. Your degree is your track record. So, once they've established you have a continuous history of earning money, they move to the second, and arguably most important question: is it consistent? This is where the math really begins. They need to distill all your earnings, every paycheck, every bonus, every side gig, down to a single usable number: your gross monthly income. If you're a salaried employee, this is a piece of cake. Your annual salary is on your employment contract, it's confirmed by your pay stub, and you just divide it by 12. If you make $60,000 a year, your gross monthly income is $5,000. Simple. But for tens of millions of Americans, it's not that clean. What if you're an hourly worker? The lender will look at your pay stubs to see your hourly rate and the guaranteed number of hours. If you're guaranteed 40 hours a week, they'll calculate your income based on that. But what if your hours fluctuate? What if you work 30 hours one week and 50 the next? In that case, they go back to the 2-year rule. They'll take your last 2 years of W-2s, add them together, and divide by 24. They are creating an average to smooth out the peaks and valleys, giving them the most realistic and consistent monthly income figure they can defend to their investors. This exact same logic applies to variable income like overtime, bonuses, and commissions. This is a huge stumbling block for people. You might have received a massive $20,000 bonus last month, and you're thinking that's going to supercharge your application. But to a lender, a single bonus is an anomaly, not a pattern. To use that bonus income, you must prove a 2-year history of receiving it. They need to see it on your last 2 years of W-2s or get a detailed breakdown from your employer. And even then, they won't just use last month's big win. They'll take the total amount of bonuses you received over the last 24 months and divide by 24. If you got $10,000 in bonuses 2 years ago and $20,000 last year, they'll add that to $30,000, divide by 24, and add $1,250 to your monthly income. It's all about proving that this extra income isn't a fluke. It's a consistent part of your compensation. Now let's talk about the group that faces the most scrutiny of all: the self-employed. Business owners, freelancers, gig workers. For you, the rules are completely different. Your pay stubs don't matter. Your bank statements showing huge deposits don't matter. The only thing that matters are your federal tax returns. Specifically, your net income after all business expenses. This is the single most misunderstood part of mortgage qualification for entrepreneurs. You might have grossed $200,000 last year, and you feel like you're flying high. But you also hired a good accountant who helped you write off $75,000 in expenses. Your car, your home office, your equipment, your travel. That's great for lowering your tax bill, but for a mortgage lender, you didn't make $200,000. You made $125,000. They used the income you actually paid taxes on. And just like with bonuses, they demand a 2-year history. They will take the net income from your last 2 tax returns, add them together, and divide by 24 to get your qualifying monthly income. This is why it's critical for any self-employed person thinking of buying a home to strategize with their accountant 1 to 2 years in advance. Sometimes, Paying a little more in taxes by taking fewer write-offs is the only way to show the income needed to qualify for the home you want. Finally, after establishing continuity and calculating a consistent monthly income, the underwriter asks the third question. Is it certain to continue? This is the forward-looking test. Your past is great, but they're lending you money for the next 30 years. They need to be reasonably sure you'll still have a job next year. This is where a document called the Verification of Employment, or VOE, comes in. After they've reviewed all your paperwork, the lender will send a form directly to your employer's HR department. This form asks them to verify your start date, your title, and your pay structure. But then it asks the million-dollar question. What is the likelihood of continued employment? If your employer checks the box that says good, you're clear. But if they indicate your position is temporary, or that there are upcoming layoffs, the entire deal can come to a screeching halt. This is also why quitting your job or changing jobs in the middle of the mortgage process without talking to your lender first is one of the biggest mistakes you can possibly make. The lender has to re-verify everything, and if your new situation doesn't fit their guidelines, your approval can be revoked days before closing. This forward-looking test also applies to other, less common forms of income. If you're using child support or alimony, you'll need to provide the court order and prove you've been receiving it consistently for at least 6 to 12 months. More importantly, the terms of the order must show that it's set to continue for at least 3 years from your closing date. If your child is 17 and a half, that child support income is about to end, and a lender can't use it. If you're using rental income from an investment property, they'll want to see lease agreements and tax returns, and they typically only use 75% of the gross rent to account for potential vacancies and maintenance. Every source of income is put through this same three-part test: a continuous history, a consistent, calculable amount, and a high probability of it continuing into the future. It's a rigorous, methodical process designed to strip away all the anomalies and assumptions, leaving behind only the most stable, reliable income figure possible. This number is the I in your DTI. It's the foundation upon which your entire qualification is built. Now that we've built this rock-solid foundation of your income, it's time to look at what's weighing it down. Because for every dollar you earn, the lender has an even more important question. How many of those dollars are already spoken for? This is the single most important question in mortgage lending. It's the question that separates dreams from reality. It's the linchpin of your entire application, and it all boils down to 3 little letters: DI. Debt to income. Your debt-to-income ratio, or DTI, is the percentage of your gross monthly income that goes toward paying your monthly debt obligations. Think of it like this. If your income is a bucket of water, DTI measures how many holes are already in that bucket before you even try to fill it. Lenders are obsessed with this number because it's their single best predictor of your ability to handle a new, and likely very large, monthly mortgage payment. It tells them how much room you have in your budget. It's the financial stress test. So let's break it down. We've already spent a ton of time on the I, your income. Now we need to tackle the D, your debt. What exactly are lenders looking for? What counts, what doesn't? And what are the hidden gotchas that can completely derail your approval? First, let's get the obvious ones out of the way. When a lender pulls your credit report, they are looking for specific types of debt accounts. These are your installment loans and your revolving debts. Installment loans are the easy ones. These are loans with a fixed number of payments over a set period of time. The big one for most people is a car loan. If you have a 5-year loan for your truck and the payment is $600 a month, that $600 goes directly into the debt side of the equation. Student loans? Absolutely. They are a massive factor, and we'll do a deep dive on those in a minute because they are incredibly tricky. A personal loan from your bank? That counts too. Any loan where you are making a consistent monthly payment to pay it down to zero over a set term is going to be included. Then you have revolving debts. The most common example is a credit card. Now here is the first critical point of confusion for so many people. Lenders do not care about your total credit card balance. They don't care if you have $5,000 or $25,000 spread across your cards. What they care about is the minimum monthly payment required on that balance. If you have a $10,000 balance on a Visa and the minimum payment reported on your credit statement is $200, the lender uses that $200 figure in your DTI calculation. And this trips people up all the time. They say, "But I pay my card off in full every month." That's fantastic financial practice, but it might not matter to the underwriter. If your statement closes on the 15th with a $3,000 balance and a minimum payment of $60, that $60 payment is what gets reported to the credit bureaus. Even if you pay the full $3,000 on the 16th, that $60 liability is already on the report that the lender sees, and it will be counted. Beyond the basics of car loans and credit cards, there are other obligations that absolutely count as debt. Things like alimony or child support payments. If you are legally obligated by a court decree to make these payments, they are factored in as a monthly debt, dollar for dollar. This is non-negotiable. I've seen deals almost fall apart at the last minute because a borrower didn't disclose a child support obligation, assuming it wasn't a debt in the traditional sense. To a lender, any court-ordered payment is a fixed liability against your income. Now, what about the things that don't count towards your DTI? This is just as important. Your monthly utility bills, gas, electric, water do not count. Your cell phone bill does not count. Car insurance, groceries, daycare, your Netflix subscription, none of these are included in the DTI calculation. Why? Because these are considered living expenses, not contractual debt obligations that are reported to credit bureaus. The lender assumes you know you have to pay for electricity and food. What they are calculating is your ability to handle your formal reportable debts on top of those basic living costs. But here's where the lines can get blurry, and where having a good loan officer is crucial. Let's talk about student loans. This is, without a doubt, the most complex piece of the debt puzzle for millions of Americans. For a long time, if your student loans were in deferment, say you were still in school, lenders might not have to count a payment. Those days are over. Today, even if your required monthly payment is zero because you're on an income-based repayment plan, or your loans are in forbearance, the lender can't just use zero. They know that eventually you will have to pay, so they have to use a hypothetical payment. For conventional loans, the standard rule is to use 0.5% of the total outstanding loan balance as your monthly payment. So if you have $100,000 in student loans, even with a $0 required payment, the lender will hit your DTI with a $500 monthly debt. For FHA loans, that rule can be different, sometimes higher. It's a phantom debt payment that can dramatically reduce how much house you can afford. If you do have a fixed, fully amortizing payment on your credit report, they'll use that. But for anyone on an income-driven plan, be prepared for the lender to calculate a payment that's likely higher than what you're actually paying. Another massive landmine is co-signed debt. This is the good deed that can come back to haunt your homeownership dreams. Let's say 5 years ago, you co-signed on a car loan for your son to help him build his credit. He's made every single payment on time without fail. You haven't paid a dime. In your mind, it's his car and his loan. In the lender's mind, it is 100% your debt. When they pull your credit, that loan is attached to your name. That $500 monthly payment is your $500 monthly payment. Now, there is a way out of this. If you can prove, usually with 12 months of canceled checks or bank statements from the primary borrower, that your son has been the one making the payments from his own account, you can often get the underwriter to exclude that debt from your DTI. But you need a perfect paper trail. If you can't provide that documentation, you are on the hook, and that debt counts against you, period. So the lender gathers all of this up. Your car payments, your student loan payments, real or calculated, the minimum payments on your credit cards, any personal loans, and any court-ordered obligations. They add it all together to get your total monthly debt. And that brings us to the actual calculation. Lenders look at two kinds of DTI. The first is the front-end ratio, also called the housing ratio. This is simpler. It's just your new proposed total housing payment, we call it PITI, principal, interest, taxes, and insurance, divided by your gross monthly income. We'll break down exactly how PITI is calculated in the next part. But the one that really matters, the number that gets all the attention, is the back-end ratio. This is the big one. The back-end ratio is your total proposed housing payment, PITI, plus all those other monthly debts we just talked about, all divided by your gross monthly income. So let's use a simple example. Let's say your gross monthly income is $10,000. Your proposed all-in mortgage payment, PITI, is $3,000. And you have a $500 car payment and $200 in credit card minimums. Your total monthly debt is $3,000 plus $500 plus $200, which equals $3,700. You take that $3,700, divide it by your $10,000 income, and you get a DTI of 37%. So what's the magic number? What DTI are lenders looking for? Generally, for a conventional loan, anything under 43% is the sweet spot. Many lenders will go up to 45, or even 50% if you have strong compensating factors like an excellent credit score, a large down payment, or significant cash reserves. But once you start pushing past 45%, the underwriting process gets much stricter. For government-backed loans like FHA, you can sometimes get approved with a DTI as high as 56 or 57%, but it's not a guarantee. Your debt-to-income ratio is the ultimate gatekeeper. It doesn't matter if you have a perfect 850 credit score and $1 million in the bank. If your DTI is too high, meaning your existing debt obligations are already consuming too much of your monthly income, the lender will see you as too much of a risk to take on a new mortgage payment. We've now covered the foundation of your income and the weight of your existing debts. We've assembled two of the three critical pieces of the DTI puzzle. But there's still that huge, glaring variable we haven't defined yet. The single biggest part of the equation: your future house payment. How in the world does a lender calculate a payment for a house you haven't even found yet? This isn't just about principal and interest. It's about predicting taxes, estimating insurance, and accounting for fees you haven't even heard of. That is the pity, and it's the key to unlocking your true borrowing power. So let's break down that acronym PITI, because this four-letter word is the absolute bedrock of mortgage lending. It's the formula that translates a giant, scary loan amount into a simple, digestible monthly payment. And that monthly payment is what everything else hinges on. First, the P, principal. This is the good stuff. This is the portion of your monthly payment that actually pays down the money you borrowed. Think of your loan balance as a giant block of stone. Every principal payment you make is a chip off that block. In the beginning, those chips are tiny, almost like dust. But over time, they get bigger and bigger until eventually the entire block is gone and you own your home free and clear. That's the goal. The principal is you, paying yourself, building equity $1 at a time. Next, the first I, interest. This is the lender's stuff. Interest is the fee you pay for the privilege of using someone else's money. In this case, hundreds of thousands of dollars of the bank's money. It's their profit, their reason for being in business. Now, here's the part that trips everyone up: amortization. In the early years of your mortgage, your payment is overwhelmingly interest. That chip you're making in the principal stone? It's tiny. The vast majority of your check is going straight to the lender as a thank you for the loan. For a 30-year mortgage, it can take years, even a decade, before your principal payment is bigger than your interest payment. It's a bit of a gut punch, but it's how the math works. The lender takes their profit first when the loan is riskiest. As you pay down the balance, the amount of interest you owe each month decreases, and more of your payment can go toward that beautiful equity-building principle. So P&I, principal and interest, are the two core components of the loan itself. They are a fixed, predictable dance that plays out over 360 months. But lenders know that the cost of owning a home is so much more than just the loan. And that's where the T and the second I come in, and where things get complicated. T stands for taxes, specifically property taxes. These aren't federal or state income taxes. These are local taxes levied by your city, your county, your school district. They pay for the things that make your neighborhood a neighborhood. The public schools your kids might attend, the fire department that will show up if the unthinkable happens, the police officers on patrol, the roads you drive on, the parks you walk in. The amount you pay is determined by the local government, based on the assessed value of your property. And here's the critical part. The lender has a massive vested interest in making sure you pay these taxes. Why? Because if you don't, the government can put a lien on your house and even foreclose on it, jumping ahead of the lender in line to get their money back. To a lender, an unpaid tax bill is a 5-alarm fire. So, to protect themselves, they don't trust you to save up for that big annual or semi-annual tax bill. Instead, they do it for you through something called an escrow account. Think of escrow as a forced savings account for your house. The lender estimates what your total property tax bill will be for the entire year. Let's say it's $3,600. They then divide that by 12, which is $300. And they add that $300 to your monthly mortgage payment. You pay them, they put that money into your escrow account, and when the tax bill comes due, they pay it on your behalf. It's non-negotiable. It ensures the government is paid, their investment is protected, and you don't get hit with a surprise multi-thousand-dollar bill you can't cover. Then we have the second I, which stands for insurance. Homeowner's insurance, to be exact. This is the policy that protects your house against catastrophes: fire, hail, a tree falling on your roof, theft. Just like with taxes, the lender demands you have it. Imagine you buy a $400,000 house, and the next day it burns to the ground. If you didn't have insurance, you might just walk away from the loan. You're not going to keep paying for a pile of ash. The bank would be left with a worthless lot and a $400,000 loss. Homeowners insurance prevents this. It ensures that if the house is destroyed, there's a pile of cash from the insurance company to rebuild it, securing the lender's collateral. And just like taxes, they don't trust you to pay the annual premium on your own. So they use that same escrow account. They'll take your annual insurance premium. Let's say it's $1,200 for the year, divide it by 12, which is $100, and add that to your monthly payment as well. So now you see the full picture. Pity isn't just a suggestion. It's the lender's complete, non-negotiable calculation of your basic monthly housing cost. It's the principal and interest on the loan, plus 1/12 of the annual property taxes, plus 1/12 of the annual homeowner's insurance premium. This is the number they will use to qualify you. But wait, it can get even more complex. For many buyers, especially first-time buyers, the acronym isn't just pity. It's PIDI-MI. That last part, MI, stands for mortgage insurance. And it's one of the most misunderstood costs in all of real estate. If your down payment is less than 20% of the home's purchase price, the lender sees you as a higher risk. You have less skin in the game. If home values drop a little, you could owe more than the house is worth, making it tempting to walk away. To counteract this risk, they require you to pay for an insurance policy. But here's the kicker. This insurance does not protect you. It protects the lender. It's called private mortgage insurance, or PMI. If you default on your loan, PMI pays the lender to help cover their losses. You are literally forced to pay a monthly premium for an insurance policy that only benefits the bank. It can add hundreds of dollars to your monthly payment, significantly reducing your purchasing power. The good news is it's not permanent. Once you've paid down your loan to the point where you have 20% equity in your home, you can request to have the PMI removed, instantly lowering your monthly payment. And we're still not done. There's one more sneaky cost that lenders have to account for: HO fees. If you're buying a condominium, a townhouse, or a home in a planned community, you'll likely have to pay monthly or annual homeowners association fees. These fees cover the costs of maintaining the community's shared amenities, things like the pool, the clubhouse, landscaping in common areas, snow removal, and sometimes even trash collection. These fees can range from $50 a month to over $1,000 in some luxury buildings. Now, HOA fees are not usually paid through your escrow account. You typically pay the HOA directly, but you can be absolutely certain the lender factors them into their calculation. They will add that monthly HOA fee right on top of your PIDI to get a grand total for your housing expenses. A $300 HOA fee has the exact same impact on your borrowing ability as a $300 increase in your property taxes. It's all just one big monthly housing number in their eyes. So, when a lender is trying to figure out if you can afford a $500,000 loan, they aren't thinking about $500,000. They are performing a complex calculation. They take the principal and interest for that loan amount. Then, they look up the typical property tax rate for the neighborhood you're looking in and estimate your monthly tax cost. They estimate a homeowner's insurance premium based on the home's value and location. If you have less than 20% down, they calculate the monthly PMI premium. And if the property has an HOA, they add that fee to the pile. They bundle all of this together to create one all-encompassing total monthly housing payment. This is the number. This is the figure that truly matters. It's the financial weight they are about to place on your shoulders. And the final ultimate question they must answer is, can your income support that weight, along with the weight of everything else in your financial life? To answer that question, they don't use a gut feeling. They don't use a magic 8-ball. They use a cold, hard mathematical formula. A formula so powerful it can single-handedly approve or deny a loan worth hundreds of thousands of dollars. It's called the debt-to-income ratio, or DTI. And if you learn nothing else about the mortgage process, you need to understand this. DTI is the lender's ultimate stress test. It is a single percentage that tells them what portion of your monthly pre-tax income is already spoken for by your debts. Think of your gross monthly income as a full pie. The lender wants to know how many slices of that pie are already promised to someone else before they take their own very large slice for the next 30 years. If too much of your pie is already gone, they won't want to risk taking another piece. They know that a person with too little pie left over is a person who is one unexpected car repair or one medical bill away from a financial catastrophe and a missed mortgage payment. So how do they calculate it? Well, the truth is, they actually calculate two DTI ratios. The first one is called the front-end ratio or the housing ratio. This one is simple. It only looks at one thing, your future housing payment. This isn't just the loan's principal and interest. They use an all-inclusive figure called PITI. That stands for principal, interest, taxes, and insurance. They take the estimated monthly cost for all four of those things, and they divide it by your gross monthly income. Let's say the house you want will result in a total PITI payment of $2,000 a month. And let's say your gross monthly income, that's your salary before taxes and deductions, is $7,000 a month. The math is simple. 2,000 divided by 7,000 is about 0.285, or 28.5%. That's your front-end DTI. For decades, the gold standard for lenders was that this number should not exceed 28%. Today, there's more flexibility, but it's still the first checkpoint. It answers the basic question. Can your income handle this specific house in a vacuum? But of course, none of us live in a vacuum. We have other financial obligations. And that's where the second and far more important ratio comes into play. This is the back-end ratio. This is the big one. This is the number that truly determines your borrowing power. The back-end ratio starts with that same PITI number, that $2,000 for your future house. But then, it adds on top of it every other major monthly debt obligation you have. We're talking about the minimum monthly payments on everything that typically shows up on your credit report. Your car loan, your student loans, the minimum payments on all of your credit cards combined, any personal loans, alimony or child support payments you're legally required to make. So let's go back to our example. Your gross income is $7,000 a month. Your future PITI is $2,000, but you also have a $500 a month car payment. You have a $300 a month student loan payment. And across a few credit cards, your total minimum monthly payments add up to $150. The lender is going to add all of that up. $2,000 for the house, plus $500 for the car, plus $300 for the student loan, plus $150 for the credit cards. The grand total of your monthly obligations is $2,950. That is the total financial weight the lender sees on your shoulders each month. Now they take that total debt, that $2,950, and they divide it by your gross monthly income of $7,000. The result is 0.421, or 42.1%. That is your back-end DTI. This is the number that keeps underwriters up at night. So what's a good number? This is where it gets interesting because the rules change depending on the loan type. For a long time, the standard for a conventional loan was a back-end DTI of no more than 36%. That was the line in the sand. Today, thanks to automated underwriting systems, that line has been pushed. It's now very common to see approvals with a DTI of up to 43% or even 45%. In some cases, with a large down payment and high credit score, some lenders might even push it towards 50%. But that's the absolute ceiling. For most people, 43% is the magic number to aim for. If you're at 44% or higher, the computer is likely going to say no, and you'll need a human underwriter to manually review your file and find a compelling reason to make an exception. For government-backed loans, the rules are slightly different. An FHA loan, for instance, is often more lenient and can sometimes allow for a DTI over 50%, but it comes with other costs like mortgage insurance for the life of the loan. Now, there are two critically important details here that people constantly get wrong. First is the I in DTI income. Lenders use your gross monthly income, not your net take-home pay. Why? Because tax rates and deductions vary wildly from person to person. One person might contribute 20% to their 401k, another might contribute nothing. One person might have high health insurance premiums deducted, another might be on their spouse's plan. Using gross income is the only way for lenders to compare all applicants on a level playing field. This is good news for you because it's a bigger number, which makes your DTI ratio lower. But it's also a danger because you don't actually live on your gross income. You live on your net. A lender might approve you for a payment that feels suffocating in your real-world budget. The second detail is the D, debt. What exactly do they count? They do not count your monthly grocery bill, your gas, your cell phone bill, or your Netflix subscription. They are looking at your contractual installment and revolving debts, the things you are legally obligated to pay each month that appear on your credit report. And here's a key tip. For credit cards, they don't look at your total balance. They only factor in the minimum monthly payment required. This is a huge distinction. You could have $10,000 in credit card debt, but if your combined minimum payments are only $200, It's the $200 that goes into your DTI calculation, not the $10,000. This single percentage, this back-end DTI, is the gatekeeper. It dictates the maximum pity payment the lender believes you can afford. And by working backwards from that payment, factoring in current interest rates, taxes, and insurance, they can calculate the absolute maximum loan amount you qualify for. A person with a 32% DTI has massive borrowing power and looks like a safe bet. A person with a 48% DTI is on the edge of a cliff. Every single dollar of extra debt you have reduces the amount of house you can buy. A $400 car payment doesn't just cost you $400 a month. It can reduce your borrowing power by $60, $70, or even $80,000. The entire pre-approval process, your credit score, your assets, your employment history, it all leads to this one final calculation. It's the moment of truth. But what happens when the math doesn't work? What if your DTI comes in too high? Is the dream just over? Do you have to wait years to pay off debt before you can even think about buying? Not at all. Because this equation isn't set in stone. The numbers can be influenced. There are powerful strategies to lower your DTI, sometimes in a matter of days. But you have to know which debts to attack first, and which actions might accidentally make your situation even worse in the eyes of the lender. So let's talk about how to attack your debt for maximum impact on your mortgage application. This isn't about the debt snowball or the debt avalanche you've heard about for personal finance. Those are great for getting out of debt, but they're not optimized for getting into a mortgage. For a mortgage, we need a surgical strike. We need the DTI scalpel. The goal isn't necessarily to pay off the highest interest debt or the smallest balance first. The goal is to eliminate or drastically reduce the highest monthly payments relative to their total balance. Here's the $1,000,000 secret. A lender cares infinitely more about a $200 monthly payment than they do about a $5,000 total balance. Let me give you a crystal clear example. Imagine you have $5,000 in cash saved up, ready to deploy to improve your DTI. You have two debts. Debt A is a $20,000 student loan with a $300 monthly payment. Debt B is a $5,000 personal loan with a $200 monthly payment. Standard financial advice might tell you to throw that $5,000 at the student loan to chip away at that big, scary number. But for a mortgage lender, that's almost useless. You'd pay $5,000, but your monthly payment might only drop by a tiny amount, if at all. Your DTI ratio would barely move. But if you take that same $5,000 and completely wipe out the personal loan, boom, that $200 monthly payment vanishes from your DTI calculation. Instantly. You just freed up $200 of borrowing power every single month. That could translate into $30,000 or $40,000 more in home price you can qualify for. It's the exact same amount of cash, but the impact on your application is night and day. You have to look at your credit report like a lender. Find the installment loans, personal loans, furniture loans, small signature loans that have relatively high monthly payments compared to their remaining balance. These are your primary targets. They are the low-hanging fruit that can dramatically change your numbers in less than 30 days. Pay it off, get a paid-in-full letter, and watch your DTI plummet. Now let's move to the trickiest category: credit cards. With revolving debt like credit cards, lenders don't just look at your actual minimum payment. It's too variable. So they often use a standardized calculation, typically 5% of the outstanding balance as your monthly payment, or sometimes the actual minimum payment if it's higher. For example, if you have a $10,000 balance on a credit card, a lender might calculate a $500 monthly payment for DTI purposes, even if your required minimum is only $200. This is a DTI killer. The strategy here is twofold. First, paying down credit card balances directly reduces that calculated payment. But second, and just as important, it dramatically improves your credit utilization ratio, which can give your credit score a significant, rapid boost. A higher credit score can get you a better interest rate, which in turn lowers your future mortgage payment, further helping your DTI. It's a virtuous cycle. The goal should be to get every single card's balance below 30% of its limit, and ideally below 10%. But here is the critical warning: the mistake that thousands of well-intentioned buyers make every year. Do not close the credit card account once you pay it off. This feels like a victory, like you're getting rid of debt. But in the eyes of the credit bureaus, you're making two huge mistakes. First, you're reducing your total available credit, which instantly makes your remaining balances look larger by comparison, so your credit utilization percentage actually goes up, hurting your score. Second, you're erasing a line of credit history. The average age of your accounts is a key factor in your credit score. Closing an old account can shorten that average age and drop your score right when you need it to be at its peak. So pay them down but keep them open. Next up, the big one for many people, auto loans. These are often the single largest non-housing payment a person has, frequently running for $500, even $700 a month. If you're on the borderline of qualifying, that car payment could be the one thing holding you back. Paying off a $30,000 car loan isn't an option for most people, but you might have other options. If you have a cosigner on the loan like a parent, and can prove with 12 months of bank statements that they alone have been making the payment from their own account, some lenders can omit that debt from your DTI. This is a specific strategy that requires perfect documentation, but it can be a lifesaver. Another potential play is to refinance the auto loan. If you can extend the term, you might be able to lower the monthly payment significantly. A word of caution here. This involves a new credit inquiry and opening a new account, which can cause a temporary dip in your credit score. This is a move you should only make in consultation with your loan officer, well in advance of your application, to make sure the DTI benefit outweighs the short-term credit impact. And that brings us to the most complex beast of all, student loans. The rules for student loans are a minefield because they differ wildly between loan types, like FHA, VA, and conventional. For years, if you were on an income-driven repayment plan and had a $0 monthly payment, some loan programs would let you use $0 in your DTI. That was a massive loophole. Those rules have been tightening. Now, most lenders have to factor in a payment, even if you're not currently paying. For conventional loans, if your credit report shows a monthly payment, they'll use that. If it shows 0 or is in deferment, they'll typically calculate a payment equal to either 1% or, more recently, 0.5% of the total loan balance. Think about that. If you have $200,000 in student loans, a lender might hit you with a $1,000 monthly payment for DTI, even if you're not paying a dime. This single rule disqualifies countless highly educated, high-earning professionals. The strategy here is to get proactive. You can't just let the lender guess. If you get on an official income-driven repayment plan, or IDR, the payment is based on your income. That calculated payment, even if it's just a couple $100s, will then be reflected on your credit report. This documented payment will often be used by the lender instead of their punitive 0.5% calculation. Going from a theoretical $1,000 payment to a documented $250 IDR payment can be the difference between getting denied and getting the keys to your new home. Finally, let's wrap this up with a rapid-fire list of things you must absolutely not do while preparing for a mortgage. These actions can undo all your hard work. First, do not co-sign for anyone on anything. Not a car, not a credit card, not a stick of gum. That debt becomes 100% your liability in the lender's eyes. Second, do not apply for any new credit. Don't finance a new couch for the house you haven't bought yet. Don't open a new store card to save 15%. Every inquiry and new account is a red flag. Third, do not make large, undocumented cash deposits into your bank account. Any deposit that isn't from your payroll needs a paper trail. Cash from a side job, money from your parents, it all has to be sourced and documented, or the lender will assume it's a new, undisclosed loan and disregard it. By surgically targeting your debts and avoiding these common pitfalls, you are no longer just a passive applicant. You are actively sculpting your financial profile to be as strong as possible. You're not changing who you are. You're changing how the system sees you. But optimizing your debt is only half the battle. Once you've cleaned up your liabilities, the underwriter's magnifying glass swings over to the other side of your balance sheet. They're no longer just looking at what you owe. They're scrutinizing every penny of what you have. And the rules about where your down payment can come from, how long it needs to be in your account, and what actually counts as a qualifying asset are just as complex, and just as full of hidden traps as everything we've just discussed. Let's start with one of the most common and most dangerous misconceptions about the down payment. It's the story of mattress money. For years, maybe you've been stashing cash away. You sold a car on Craigslist for cash, you got a big cash bonus, or maybe your incredibly generous Aunt Carol just handed you a thick envelope with $10,000 in it for your house fund. You think, great, I'll just deposit this into my checking account. More money for the down payment, the lender will love this. And in that one simple act, you may have just torpedoed your entire mortgage application. Why? Because to a lender, a large, sudden, undocumented cash deposit isn't a sign of wealth. It's a giant flashing red flag. It's a 5-alarm fire of risk. They have no idea where that money came from. Was it a loan from a loan shark you have to pay back with crushing interest? Is it from illicit activities? Is it a gift from your Aunt Carol that she actually expects you to repay, creating an illegal undisclosed debt? The lender doesn't know, and they aren't going to take the time to find out. They're just going to see it as a potential liability and could deny your loan on the spot. This brings us to the first critical rule of assets: seasoning. Lenders want to see that the money you're using for your down payment and closing costs has been seasoned. Just like a cast iron skillet, your money needs to sit in your account for a period of time to prove that it's truly yours, free and clear. The industry standard for seasoning is 60 days. That's why lenders require, at a minimum, your last 2 full months of bank statements for every account you're using. They want to see the money sitting there day after day, week after week. They're looking at the opening balance 60 days ago, and the closing balance today, and they're scrutinizing every single large deposit and withdrawal in between. Any deposit that isn't from your regular, verifiable payroll is going to be questioned. That $10,000 cash deposit sticks out like a sore thumb. So what do? The key is planning. If you have cash, deposit it into your account at least 3 months before you even think about applying for a loan. Let it sit there. Let it season. By the time you hand over your bank statements, that deposit will be more than 60 days old, and in most cases it will be out of the lender's line of sight. But what if you can't wait that long? What if you need that money now? This is where the second rule comes in: sourcing. Every large, non-payroll deposit within that 60-day window must have a clear, clean, and unimpeachable paper trail. You have to prove beyond a shadow of a doubt exactly where that money came from. Let's go back to Aunt Carol's $10,000 gift. For this to be an acceptable source of funds, you can't just deposit it. First, you need a formal gift letter. This is a signed document that explicitly states the donor's name, their relationship to you, the exact dollar amount of the gift, and most importantly, a sentence that reads something like, "This is a bona fide gift, and there is no expectation of repayment, ever." Both you and Aunt Carol have to sign it. But that's not enough. You then have to show the money moving. The lender will want to see a copy of Aunt Carol's check, or the wire transfer confirmation. They'll want to see it leaving her account and arriving in yours. In some cases, especially with FHA loans or if the gift is very large, the lender may even ask for Aunt Carol's bank statement to prove she had the funds to give, and that her account wasn't suddenly funded by another mysterious source. It sounds invasive, but their job is to eliminate the possibility of fraud and undisclosed debt. The same principle applies if you're selling something of value. Let's say you sell your classic car for $20,000. You need a complete paper trail. You'll need a copy of the fully executed bill of sale, signed by both you and the buyer. You'll need a copy of the vehicle title, signed over to the new owner. You'll need a copy of the cashier's check or wire transfer from the buyer. And you'll need your bank statement showing that exact amount being deposited. You have to connect the dots for the underwriter, leaving no gaps in the story. From car to title to check to deposit, it has to be a closed loop. Another extremely common source for down payments is a retirement account, like a 401k or an IRA. This is your money, so it's generally an acceptable source, but the rules are strict. You typically have 2 options: a loan or a withdrawal. If you take a 401k loan, you're borrowing against your own retirement funds and paying yourself back with interest. The lender will need to see the loan terms from your plan administrator. And here's the critical part: that new loan payment, even though you're paying it to yourself, will be added to your monthly debts and factored into your debt-to-income ratio. A $500 a month 401k loan payment has the exact same negative impact on your DTI as a $500 a month car payment. If you take a withdrawal instead, you avoid a new monthly payment, but you'll likely face significant income taxes and early withdrawal penalties. The lender will need to see the statement from the retirement account showing the funds being withdrawn, and the bank statement showing them being deposited. They will also make sure you still have enough money left over to cover any taxes and penalties, so you don't find yourself in a financial hole later. So you've seasoned your funds, you've sourced your large deposits. You're done, right? Not yet. Now we come to the third rule, the final check: sufficiency. Do you actually have enough money? The lender calculates the total cash to close, and you have to prove you have every single penny of it, plus a buffer. This total isn't just your down payment. First, you have the down payment itself, 3, 5, 20%, whatever your loan program requires. Next, you have closing costs. These are the fees for the services required to close your loan: the appraisal fee, title insurance, lender origination fees, attorney fees, recording fees, and so on. A good rule of thumb is to estimate closing costs at 2% to 5% of the purchase price. On a $400,000 home, that could be anywhere from $8,000 to $20,000 on top of your down payment. Then you have what are called prepaids. The lender will require you to prepay for certain items, like your first full year of homeowner's insurance. They'll also set up an escrow account to manage your future property tax and insurance payments. To start that account, they'll need to collect a few months' worth of those payments from you upfront at closing. This can easily add several thousand more dollars to your cash-to-close figure. But the final piece of the sufficiency puzzle is the one that trips up so many hopeful buyers: reserves. Reserves are the amount of money you have left over after you've paid your down payment and all your closing costs. It's your post-closing liquidity, your emergency fund. Lenders need to see that the purchase won't leave you with a $0 balance in your bank account. They want to know that if you lose your job or your air conditioner breaks the month after you move in, you'll still be able to make your mortgage payment. The reserve requirement varies depending on the loan type, your credit score, and the property type. For a standard single-family home with a strong application, they might want to see 2 months of PITI, that's principal, interest, taxes, and insurance, left in your account. So if your total monthly house payment is $3,000, you'll need to have an extra $6,000 in liquid, verifiable funds left over after closing. If you're buying an investment property or a multifamily home, the requirement can jump to 6 months of PITI or even more. That's a massive amount of cash that many people simply don't account for. So you've navigated your income, your credit, your debt, and now your assets. You've provided every statement, every letter, every piece of paper they've asked for. You're at the finish line, right? Well, not quite. Because now all of this goes to the final gatekeeper, the underwriter. And their job is to find the one tiny crack in your story that could bring the whole thing crashing down. Think of the underwriter not as a person, but as a human lie detector for financial risk. Their name isn't on the loan application. You will likely never speak to them, but they hold the entire fate of your home purchase in their hands. They are the judge, jury, and often the executioner of loan files. Their one and only job is to protect the lender from making a bad loan. They answer to the bank, to investors, and to government-backed entities like Fannie Mae and Freddie Mac. And they do this by meticulously stress testing every single piece of information you've provided. Everything you've learned so far, your credit score, your debt-to-income ratio, your assets, was just the preliminary round. The loan officer's job was to assemble the story. The underwriter's job is to poke holes in it. They take the 3 Cs of lending, capacity, credit, and collateral, and put them under a microscope. Let's start with your capacity, your ability to repay. The loan officer calculated your DTI, and it looked good. But the underwriter asks deeper questions. Where does this income really come from? You got a huge promotion last month that pushed you over the qualification line. Fantastic. The underwriter, however, sees a potential risk. They'll ask for a letter from your employer explaining the promotion. They want to know if your pay structure changed from a stable salary to a variable commission. If it did, they might only be able to use your previous lower salary because you don't have a 2-year history of earning that commission. They look for stability and predictability. That side hustle you've been doing for 6 months? To an underwriter, it barely exists. They need to see 2 years of tax returns showing consistent income from that source before they'll count a single dollar of it. They are looking for reasons to say no because every no is a risk avoided. Then they move to your credit. They have your credit report, the same one the loan officer saw, but they read it differently. They aren't just looking at the 3-digit score. They're reading the narrative. They see that 130-day late payment on a credit card from 2 years ago. Your loan officer might have ignored it, but the underwriter wants to know why. You'll be asked to write a letter of explanation, or LOX. Was it a simple oversight? A dispute with the company? Or was it a sign of financial distress? They'll scrutinize recent activity. Did you apply for 3 new store credit cards last month to get a 10% discount? To them, that's not smart shopping. It's a red flag. It signals you might be overextending yourself right before taking on the biggest debt of your life. They're trying to understand your character through your financial habits. Finally, they analyze the collateral, the house itself. The appraisal report lands on their desk. It says the house is worth what you're paying. Great, right? The underwriter doesn't just take the appraiser's word for it. They review the report with a critical eye. Were the comparable properties, the comps, really similar? Was one of them a foreclosure sale that skewed the value? Is the property located in an area with declining home values? They'll run their own automated valuation models to cross-reference the appraiser's conclusion. They'll review the title search to make sure there are no hidden claims or liens against the property. They're not just making sure the house is a good home for you. They're making sure it's a safe investment for the lender in case you default and they have to foreclose. This intense scrutiny leads to the most nerve-wracking phase for any homebuyer: underwriting. This is where deals die. And they usually die over things that seem small. The number one killer? Undocumented cash. Let's say your parents gave you $20,000 for a down payment. You deposited the check and the money is in your account. To you it's a gift. To an underwriter it's a giant flashing red light labeled mystery money. They have to assume the worst-case scenario, that it's actually an undisclosed loan from your parents that you have to pay back. Why? Because that repayment would affect your debt-to-income ratio. To solve this, you need a formal gift letter, signed by your parents, stating the money is a true gift with no expectation of repayment, along with a paper trail showing the money leaving their account and entering yours. Every large, non-payroll deposit in your bank statements for the last 2 to 3 months will be questioned. Sold a car on Craigslist for $5,000 cash? You better have a bill of sale and a copy of the vehicle title transfer, or that money is unusable. The second deal killer is new debt. You got pre-approved. You found the perfect house. You're feeling good. So you go out and finance a whole living room set for your new home. You've just committed a cardinal sin of home buying. Lenders will do a soft pull on your credit again, right before closing. When they see that new loan, they have to recalculate your DTI. If that new furniture payment pushes your DTI over the limit, your loan is denied. Days before closing. It happens all the time. From the moment you apply for a mortgage until the moment the keys are in your hand, you are in a financial quiet period. No new credit cards, no new car loans, no co-signing for anyone. Don't even change your cell phone plan if it requires a credit check. You are a financial ghost until the deal is done. After a few days or sometimes a week of agonizing silence, you'll get a notification from your loan officer. It's rarely a simple yes. More often, it's something called a conditional approval. This is a huge step forward. It means the underwriter has reviewed your file and is willing to approve the loan if you can satisfy a list of conditions. These conditions are the underwriter's final checklist. They might be simple: provide your most recent pay stub, or they might be more complex. Provide a letter of explanation for the overdraft fee on your bank statement from 2 months ago, or provide proof that the old collection account from that medical bill has been paid in full. Your job is to gather these items as quickly and accurately as possible. Each document you send back goes into a queue for the underwriter to review. This can sometimes feel like a game of whack-a-mole, but it's the final stretch. Once every single condition has been met to the underwriter's satisfaction, they will issue the 3 most beautiful words in the entire home buying process: clear to close. This is the finish line. This is the official green light. It means the underwriter has stamped their final approval on your file. The lender is now legally committed to funding your loan. Your loan officer will call you, there's a moment of celebration, and then the focus shifts to scheduling your closing date, where you'll sign a mountain of paperwork and finally get your keys. So what's the ultimate secret to getting a mortgage? It isn't having a perfect 850 credit score or a 7-figure income. It's about telling a clear, consistent, and verifiable story of your financial life. Every number, every document from your pay stubs to your bank statements is a sentence in that story. The lender's entire process, from the initial application to the final underwriter's review, is designed to do one thing: verify that your story is true. They're trying to predict the future by meticulously examining your past. You now understand the why behind every request they make. Why they care about a tiny medical collection from 5 years ago. Why they need a letter for a $5,000 deposit. Why you can't buy a new refrigerator before closing. You're no longer just a passive applicant. You're an informed participant. You can anticipate their questions. You can prepare your documents. You can avoid the common pitfalls that derail so many others at the very last minute. The goal isn't to be a perfect borrower. The goal is to be a transparent and prepared one, because the story you're telling isn't just about getting a loan. It's about proving you're ready for the responsibility and reward of homeownership. And that house, that property you've worked so hard for, is more than just collateral on a loan. It's the next chapter you've just earned the right to write.